So investment managers here at JM Fin still retain two roles, being firstly the relationship manager for clients, but also managing their investments. So therefore, we need to be very good at multitasking, in my view. There's an enormous amount of work done both on administrative and investment matters. The second aspect, I think, which is very important, is that managers need to be a good listener. We receive vast quantities of information from not only clients, but company executives, fund managers each day, and therefore we need to be very good at listening to those people to ensure that we get good outcomes for clients on their portfolios. And finally, it'd be remiss of me not to mention to have a good team around the investment manager, which fortunately I do. A good active investment manager, I think, must be oblivious to short-term noise in the market. I think you need to have the courage of your convictions when picking investments. However, I think also an important aspect to have is to admit when you're wrong, which is easier said than done. One example I had in my career was about 10 years ago when we invested in a company called Yale Group, which was the company behind the Yellow Pages that arrived on everyone's doorsteps. We met with the company after making an initial investment and quickly realized that the situation had changed. We acted on our conclusions from the meeting and sold the investment. And although we crystallized a small loss, we saved clients money over the longer term because the company eventually went bust. I do not actually. I think passive investments have a role to play for investors in today's investment world due to their simplicity and their low-cost nature. I do worry, however, that the meteoric rise we've seen in the assets going into passive investments may exacerbate any potential market sell-off going forward. Looking at the active management world, in the past there was a number of funds from fund management houses that were pseudo-tracking funds, what I'd like to call the mediocre middle, and those products have now been removed predominantly from suites, and therefore me as an investor have a better selection of active funds to choose from. Well, within the FTSE 100 there are a lot of companies that generate a lot of their earnings from overseas. However, the index has a bias towards certain sectors, namely mining, banks, pharmaceuticals and oil and gas. But within those particular sectors, there's a very short list of stocks you can buy, namely BP or Royal Dutch Shell within oil and gas, or AstraZeneca and Glaxo within the pharmaceutical sector. So we feel that this is a dated and suboptimal way to get exposure to big global companies. Looking overseas, we can broaden our perspective. We'd expect clients to see us as buying the best of breed companies from overseas and hold them on their portfolios. And this has enabled us to do this by adopting this new approach. We've also shifted away from the UK more so since June 2016 when we had the Brexit vote. Yes and no. Yes, because the situation we've got with the negotiations between the UK and EU are ongoing, and we have no idea still about how the land will lie after March 2019. We also have the outside chance that there may be a change of government coming through at some point. This is having a big impact on certain sectors within the market, namely utilities. Utilities have been under the cosh due to the political environment. But conversely, no, because international investors view Brexit really as a sideshow, and what's more important to them are the fortunes of the US and Chinese economies. These economies are doing quite well at the moment, so this is going to be good for global company earnings on the whole. And therefore, given that we are now looking more on a global basis at JM Fin, we see the opportunity set opening up for us to be able to buy better companies for client portfolios.